Aloha, this is Kurt Nielsen with eMortgage Hawaii. I want to welcome you to this informative workshop where I'm going to be talking about a much needed loan program called HARP 2. This is really a let's try it again by the U.S. government, but this time I do think they have it right. The question I hope to be answering for you today is what this loan can do for you or perhaps your family, your friends, or your clients. So let's start off by talking about who this workshop is really for. It's for anybody who wants to lower their interest rate but haven't qualified in the past for a conventional refinance because they're upside down on their loan, or perhaps they have other issues like challenged credit. I'm also going to talk about the program, who qualifies, where you can get this loan, and just some basic lender guidelines. Finally, if after you review this video you have more questions, simply call the number that you see at the bottom of the screen. We'll have a private conversation about your exact situation. So are you upside down on your house? With HARP 2, you can refinance at today's low rates no matter what your home is worth. So let's jump right in and talk about what HARP 2 really is. First of all, HARP stands for Home Affordable Refinance Program. It is a special program designed for those people who have either a Fannie Mae or a Freddie Mac loan, and allows people to refinance their loan through expanded criteria. In layman's terms, that just means looser guidelines. These would be people that might have trouble qualifying with today's tough credit standards, or for those who have negative equity in their home due to declining home markets. We call this being upside down. This is restricted to conforming Fannie Mae or Freddie Mac loans, which are generally below $625,500. There are exceptions to this. There are jumbo conforming and what we call high balance loans that Fannie Mae and Freddie Mac offered in some areas of Hawaii, which had balances as high as $793, $750. These may qualify under HARP. The great thing about HARP is that it also allows you to refinance not only primary but secondary and investment loans. Many people had the misunderstanding that this was only for primary homes. That is not the case. Now let's be clear about one thing. This is not a loan modification. If you owe $300,000 on your home right now, you're still going to owe $300,000, but it lets you lower your interest rate and most likely your payment. So let's start with some of the easy stuff. Who is going to be able to get these loans? It starts off by one requirement, that anyone with a conforming Fannie Mae or Freddie Mac mortgage that closed prior to June 1st, 2009 can qualify for this loan. If you got a loan after June 1st, 2009, you are not eligible for this program. Another question I get is, do you need other hardships other than just negative equity? The answer is no. In fact, there are no hardship requirements other than negative equity for this program. Now, the biggest thing that we face is we still have to show that the borrower is capable of paying their bills. In fact, the program requires that the homeowners are current on their mortgage and have had no late payments for the last 6 months, and only one late payment in the 6 months prior to that, essentially months 7 to 12. So if you have any late payments now, you might have to wait for a few months until you qualify under those conditions. The other thing it allows for, aside from looking at negative equity situations, is that there are less restrictive guidelines on things like debt to income and FICO scores. This should help people who may have been self-employed and got a stated income loan years ago. The underwriting does allow for higher debt to income ratios in the HARP program than standard conventional loans right now. So let's now talk about the borrower. First of all, will there be any income requirements for the refinance? This is not really a black and white issue. If you're lowering your payment, and depending on which lender you use, you may not have to qualify on income whatsoever. The next thing is verification of employment. According to the guidelines posted on efanniemae.com, here's what they say. The lender must obtain a verbal verification of employment and verify the borrower's source of non-employment income, plus obtain any other income documentation as required by the findings report. basically what we do, we upload your loan into Fannie Mae or Freddie Mac, and the system just spits out a little list of items that we have to provide about you. So sometimes it doesn't even require any income verification. Now there is one exception. If the borrower's principal and interest payment is going to increase by more than 20% based on this refinance, the borrower must requalify as if it were a new loan, and including verification of income sources and amounts and verification of assets needed to close in accordance with standard underwriting requirements. Remember too, it also depends on which lender you're dealing with. They may have their own guidelines. Now I know what you're asking, why would somebody want to refinance and have their payment go up by more than 20%? And the answer is that some of you may have an interest-only loan or an adjustable rate loan that is artificially low right now, and it is getting ready to adjust big time. Or some of you might find it worth going from a 30-year loan to maybe a 15 or 20-year loan because of the extremely low rates right now. So it all depends on the situation. The next issue is DTI. Are there going to be any debt-to-income requirements? That kind of falls under the previous question about income. It really does depend. Debt-to-income is the ratio between what you are paying in monthly housing and other debt expenses divided by how much you earn on a gross amount basis. So here again, some lenders may add their own guidelines as far as DTI. Again, Fannie Mae has not posted anything as a hard and fast rule except for when the payment is increasing by the 20% that we talked about. The rule of thumb is that you need to be at a debt-to-income ratio of 45% if you're increasing your payment by 20%. If somebody's in a 30-year fixed mortgage and they're taking advantage of these great 15-year rates, then they do have to meet that DTI threshold. Now, if you're lowering your payment, you may not have to meet any income or debt-to-income ratios. Again, it depends on your situation and the lender that we use. And again, I think that's another reason why you should work with a broker like me, is that we can select which lender we should go to based upon your specific scenario. The next thing is about credit scores. Again, it's very similar to the previous items, that the credit, Fannie Mae has not come out with any requirement on FICO score unless the payment is increasing by more than 20%. If it is increasing by more than 20%, you need a 620 FICO score. If not, if you're just somebody who's refinancing a 30-year fixed into a new 30-year fixed and reducing your payment, Fannie has no credit score requirements. Now that doesn't mean that the individual lender may not layer on a FICO score requirement, but Fannie does not. The next one is verification of assets or reserve. Do you have to show how much money you have? And again, it depends. If you are increasing your payment by 20%, you will have to verify assets. If you're not, we may not have to look at assets at all. Finally, what if there were two people on the loan and you wanted to take one person off? Let's use divorce as an example. First, it's really not that easy to do, but it is possible. You have to show evidence that the remaining borrower has made the past 12 mortgage payments using their own funds. That means that you have to have made payments from an account that doesn't have anybody else on it. So that is very restrictive. Now what about the other way around? What if you want to add somebody? Well, the answer is you can add borrowers, but I wouldn't do that unless you absolutely had to. For example, if they are requiring income verification and you don't have the income to meet it. But you can add borrowers. They just need to qualify under the same guidelines as the original borrower. So let's talk about some loan details. Is there a maximum loan to value? The loan to value is defined as a loan balance divided by the property value. So let's say, for example, your loan balance is $400,000 and the value of the home is $300,000. So you're upside down by $100,000. Your LTV in this case would be 133%. So the question is, can you refinance with 133 or 150% loan to value? The answer for the most part is there is no LTV limitation. It used to be 125%, but that has changed. If you're going into a mortgage like a 30-year, 15 or 20-year fixed, you can have any LTV. However, there are caps for unique products like ARMs or the 40-year mortgage. So you just need to call my office and we'll go through your scenario to find out if there's an LTV limit. But generally, if you're going into a 30-year fixed, there's not going to be a limit. How will value be determined? And this kind of goes along with, will there be an appraisal? Since there isn't an LTV limit, you would think that they wouldn't need an appraisal. A lot of times they'll ask for an appraisal just to make sure that the condition of the home is livable and it hasn't been torn apart. Each loan does require field work, and appraisal is part of that field work. The following transactions do get a waiver from field work if they're a one-unit property, a primary residence, a second home, or an investment property. Currently, the field work waiver will not be offered on cooperative units, manufactured homes, 2 to 4 unit properties, or a loan case file where we've received an eligible recommendation once we've uploaded you into Fannie Mae or Freddie Mac. So the long and the short of it is, most of the time there won't be an appraisal required, but depending on your file, it could. As far as determining value, if there's not an appraisal, most of the time it'll be done through their automatic system. What if you have a second mortgage or a home equity line of credit? So let's say a house is worth $250,000 and you owe $250,000 on the first mortgage. And you also have a $100,000 second mortgage. How does that work? Well, HARP will allow us to refinance the first mortgage and leave the second mortgage in place. The second mortgage holder has to agree to be put back into second position behind the new first mortgage. This is called subordination. If they don't agree, the loan cannot be done. However, if you are lowering your payment on the first mortgage and not increasing the loan amount, typically the second lien holder is happy to subordinate because it just improves the chances of you being able to afford to pay both mortgages. Another question I get is whether the second or HELOC or a construction loan perhaps could be rolled into the first mortgage through HARP. The answer is no. You are not able to refinance and combine other loans into the first mortgage. The product is strictly for the current first mortgage. If there is a second, they have to subordinate or you have to pay it off. Next, what about a change in occupancy? What if you bought the property as a primary residence and now it's either a second home or you've rented it out and moved out? The great thing is this program, it has no restrictions on occupancy type. Primary residence, second home, investments are all eligible as long as they are one-unit properties. And finally, I get questions about if the property is for sale, can you still refinance? And it looks like Fannie Mae has no requirements to taking the home off the market. Generally, you used to have to take the home off the market. Now, you might have lenders requiring the home to be taken off the market, but Fannie Mae just doesn't require it for right now. Let's talk a little bit about other details and underwriting guidelines. Another question I get is if there's a seasoning requirement if somebody has gone through bankruptcy or foreclosure. The answer is no. As long as you're not in the middle of a foreclosure or the middle of a bankruptcy, you can refinance. So that's fantastic. So that allows, again, some credit-troubled people to get refinanced where you couldn't do it in normal underwriting guidelines. Well, what about jumbo loans? Jumbo loans by definition are not owned by Fannie Mae and Freddie Mac, so by definition they don't qualify. However, your jumbo loan may not be a jumbo. It still may be a conforming loan because Fannie Mae and Freddie Mac offered what we called jumbo conforming or high balance loans that were still purchased by Fannie Mae and Freddie Mac. So you just need to give me a call. We can find out if your loan is owned by Fannie Mae or Freddie Mac. And I think on Oahu the loan amount got as high as $793,750. So you still may have a conforming loan, although it's the balance might be higher than $625,000. And finally, how long is the program available? Well, the program ends at the end of 2013. But if you qualify right now, I would get the loan done. I mean, interest rates are extremely low right now. We don't know where they're going to be in 2013. They might be back up to where your loan interest rate is right now. And also, if you qualify now for this HARP program, you might as well take it because you never know what could happen to you. If you lose your job or something happens personally, you may qualify now, but you may not qualify in a year from now. So, I think it's good. If the going is good, get it done now. So how long does it take to close? Normally it's just 45 days. If this program really does bring on a lot more loans, we might see lenders getting jammed up, and it might take 45 to 60 days. But just be patient. If you set your expectations at 45 to 60 days, if we get it done earlier, you'll be happy. Remember, this is a loan that you probably thought you would never get. The interest rates are great. I think right now you can get loans as low as, certainly below 4% depending on certain conditions. So, it's just a really good time, to get the loan done and get it refinanced. Now, what if your loan isn't owned by Fannie Mae or Freddie Mac? And the bottom line is that this program is only for those loans. Now, if you have an FHA, you might be able to get an FHA streamline refinance, so you just give me a call and see if we can do that. But if it's any other loan, basically there are no other programs out there that are like HARP. You can always go directly to your lender if it's a portfolio loan and try to negotiate a modification. There are loan officers out there that specialize in loan modifications. Again, if you want me to give you a referral, I know some pretty good people, just give me a call regarding loan modifications. The bottom line, if you've been told by your bank that you don't qualify or you're ineligible, a lot of things have changed. You might as well give us a call and see what we can do for you, even if you think you aren't eligible. Listen, the call is free, our looking at the deal is free, and we might find that you do qualify for a refinance. So again, thanks for listening. I'm Kurt Nielsen at eMortgage Hawaii. There's my email, my telephone number. Give us a call, and if you're interested in other types of loans too, we'd certainly like to work with you. Thanks a lot.